A few days ago, the U.S. Bureau of Labor Statistics released the inflation data for March. The U.S. Consumer Price Index, CPI, increased by 2.4% year-on-year in March, falling short of market expectations. The core CPI rose to 0.8% year-on-year, marking the smallest increase since March 2021. Amid the intense tariff war, the bearish trend in U.S. stocks, and investors' eager anticipation of interest rate cuts, this moderately cooled down inflation data seemed to send a signal to the market, providing the Federal Reserve with an excuse to cut rates. Some Fed governors even hinted in advance that they supported earlier and more significant rate cuts than previously expected. However, just as the market started to expect imminent rate cuts, a statement from Federal Reserve Chair Jerome Powell dashed investors' hopes. First, Powell acknowledged again that the scale of Trump's tariff policies had exceeded expectations, and it was highly likely to cause a temporary rise in inflation, possibly even leading to more persistent inflationary pressures. He pointed out that as an import tax, the historical impact of tariffs on inflation had been inconsistent, but the broad scope of Trump's tariffs might change this pattern. The Federal Reserve has a dual mandate: maintaining an inflation target of 2% and promoting full employment. If inflation surges, the Fed may need to maintain high interest rates or even raise them to keep it in check. If economic growth slows, rate cuts may be a more appropriate response. But currently, the Fed faces a difficult dilemma as these two objectives are in conflict. In a sense, the Fed is like a goalkeeper facing a penalty kick, having to decide whether to focus on inflation by diving to the right or on employment growth by diving to the left. Regarding this difficult choice between employment and inflation, the Fed has chosen the former. Powell believes that without stable prices, a long-term and robust job market cannot be achieved. In essence, this means that when the two goals conflict, the inflation target takes precedence over the employment target. Powell further stated that tariffs are likely to push us further away from the inflation target, at least for the rest of this year. Therefore, he reiterated that the Fed is in no hurry and does not need to adjust interest rates for now. It will patiently wait until the impact of trade policies becomes clearer before making a decision. This is almost a direct challenge to Trump, making it clear that as long as the trade war continues, rate cuts will not happen. This stance triggered a new wave of fierce criticism from Trump towards the Federal Reserve. It's quite a spectacle to see a president launching a scathing attack on a central bank governor on social media. Trump's remarks came just as the European Central Bank was expected to implement its seventh interest rate cut. He posted, "Once again, the Fed is too late. Powell always gets it wrong and is always behind the curve." Yesterday's report was yet another classic example of a complete disaster. He added, "Oil prices, food prices, even egg prices are dropping. The US is getting rich through tariffs. The Fed should have cut interest rates long ago, just like the European Central Bank. It should take action immediately now." Finally, Trump added, "The sooner Powell is removed, the better." It remains unclear whether Trump's remarks refer to the natural end of Powell's term or if he intends to remove him immediately. The White House has not yet commented on this. According to the schedule, Powell's term as Fed chair will last until May 2026, and his term as a governor will end in February 2028. While on this topic, let's take a moment to understand the Federal Reserve, the most powerful institution in global monetary affairs. The Federal Reserve has a three-tiered system. The first tier is the Board of Governors, the highest authority within the Fed. According to US law, the board consists of 7 members, including a chair, 2 vice chairs, and 4 governors. All board members are nominated by the president and must be approved by the Senate. The terms of the chair and vice chairs are for years and can be renewed once, and they are nominated from among the current board members. For example, Powell was nominated as chair by Trump in 2018 and was renominated by Biden in 2022, so his current term as chair will end in May 2026. However, the term for governors is 14 years. If a chair's term ends, but their governor term has not, they can continue to participate in decision-making as an ordinary governor. Thus, although Powell's chair term ends in 2026, his governor term will last until 2028. The second tier consists of 12 regional Federal Reserve banks, including those in New York, Philadelphia, Boston, Chicago, Kansas City, etc. The third tier is the Federal Open Market Committee (FOMC), which is the key. The committee has 12 members, each with one vote, and they ultimately decide whether the Fed will cut interest rates. Among these 12 members, 7 are from the Board of Governors, and the President of the Federal Reserve Bank of New York has a permanent vote. The remaining 4 votes are allocated to 4 presidents from the other 11 regional Federal Reserve banks, who are selected on a rotating basis and change annually. The FOMC holds 8 regular meetings each year to assess the economic situation, primarily focusing on inflation and employment, and then votes on whether to cut interest rates. The opinion of the Federal Reserve Chair carries significant weight within the committee. Judging from Trump's stance, he seems unwilling to wait until Powell's term expires. However, while the president has the power to nominate, he lacks the authority to appoint or dismiss Federal Reserve officials. So, does Trump have a way to remove Powell? The first approach. As previously reported by the media, Trump once planned to appoint an unprecedented shadow Fed chair after his second inauguration to undermine Powell's influence. The strategy involved nominating the next Fed chair 2 years before Powell's term ended and encouraging the nominee to frequently comment on the market. It was rumored that Trump abandoned this plan, likely hoping to exert pressure on Powell through various means. But so far, Powell has remained unyielding. The second method, which Trump has been pursuing recently, is to dismiss Powell ahead of schedule. He has petitioned the U.S. Supreme Court to allow the direct removal of David Wilcox from the National Labor Relations Board and Burleigh Howell from the Merit Systems Protection Board. These individuals hold high-ranking positions in independent agencies. How does this relate to removing Powell? Trump is challenging the 1935 Humphreys Executive v. United States ruling, which prohibits presidents from arbitrarily removing heads of independent agencies. These agencies are designed to operate independently and not be entirely subservient to the White House. However, Trump argues that this law is unconstitutional, citing Article 2 of the Constitution, which states that the executive power resides with the president and that all major government departments are under the president's direct supervision. Trump has requested the Supreme Court to hear the case in May, aiming for a resolution before the court goes on recess in June or July. Is it possible for his request to be approved? There is a real chance. In recent years, the Supreme Court has shown signs of shifting. For instance, in 2020, it allowed the president to remove the director of the Consumer Financial Protection Bureau (CFPB), reasoning that such crucial executive positions must answer to the president. This year, Trump indeed removed the CFPB director. The key now is whether this logic can be applied to independent agencies composed of multiple members. With 3 conservative justices appointed by Trump on the Supreme Court, there is a strong likelihood they will support this claim. If successful, Trump could gain significant influence over the Federal Reserve. Whether it's inserting a shadow chair to push for aggressive rate cuts or using a Supreme Court ruling to undermine the Fed's independence, Trump aims not just for the Fed's cooperation, but complete control to advance his agenda. The broad outline of his plan is already emerging, reinventing the trade system while suppressing China. According to a Wall Street Journal report on April 15th, Trump intends to use tariff negotiations to pressure more than 70 countries. He demands that these nations prevent China from transshipping goods to the US through their territories, block Chinese companies from setting up factories to evade US tariffs, and restrict the entry of Chinese low-cost industrial products into their domestic markets. The immediate goal is to force US trading partners to economically isolate China, with the ultimate aim of weakening China's economy and reducing its leverage in US-China trade negotiations. Now that the objective is clear, in the coming period, both China and the US will pull out all the stops. Tactics will include, but not be limited to, courting neighboring countries, sowing discord among each other's allies, and competing over economic data. According to sources quoted by the Wall Street Journal, during preliminary talks with several countries, US officials have already proposed restricting Chinese goods and investments. Japan recently held the first round of negotiations with the Trump administration. While Trump claimed significant progress, the Japanese side stated that no agreement was reached. The two sides have scheduled a second round of talks within this month. Although the details remain undisclosed, Japanese Representative Ryusei Akasawa told Japanese reporters that he was extremely disappointed with the tariff negotiations and hoped the US would present an agreement to strengthen bilateral economic ties. Trump has already resorted to raising tariffs to pressure negotiations. However, whether he can achieve the goal of forcing other countries to take sides remains uncertain. At least in the short term, severing economic ties with a country that accounts for 1/3 of global manufacturing capacity is no easy decision for most nations. Even US allies with strong ideological alignment are likely to adopt a wait-and-see approach, stalling and negotiating simultaneously. In contrast, China has been actively engaging in Southeast Asia recently, signing strategic cooperation agreements with countries like Vietnam and Malaysia to strengthen regional relations. China's first quarter GDP data is also intriguing. The 5.4% growth rate exceeds that of the entire previous year. At first glance, the figure looks impressive, but a deeper analysis reveals nuances. Industrial growth reached 6.5%, with manufacturing up 7.1%, equipment manufacturing 10.9%, and high-tech manufacturing 9.7%. In essence, manufacturing enterprises, fearing future tariff hikes, are rushing to fulfill orders before policies are implemented. Regionally, coastal provinces such as Jiangsu, Zhejiang, Shanghai, and Guangdong contributed the most, as they are highly dependent on US exports. Once tariffs are adjusted, these areas will face the most pressure, hence their efforts to complete as much work as possible in the first quarter. When tariffs take effect in the second quarter, coastal enterprises may face an order drought, and for now, there is no clear solution in sight.